This new AI ETF is nothing like the others. Almost every AI ETF out there is making the same mistake. They are all chasing the same handful of mega cap stocks, creating a sea of sameness. But what if the whole AI revolution isn't just about processing power? What if it is starting to hinge on a component most of these funds are totally ignoring? A brand new ETF is making a radical bet that the future of AI isn't just about the brains of the operation, but its memory. And in doing so, it's building a portfolio that looks completely different from anything you've seen. Let's focus the problem: a sea of sameness. Pull up the holdings of the most popular semiconductor ETFs. They are starting to look like photocopies of each other. Take a giant like 1X Semiconductor ETF, ticker SMH. Its top positions are the usual suspects of the AI boom, such as Nvidia, TSMC, and Broadcom. These three names alone make up a massive slice of the fund. This isn't automatically a bad strategy. These companies are titans for a reason, right? They are the architects of the AI we have today. But it creates a huge problem for anyone looking for actual diversification. When you buy these ETFs, you are not really buying the whole semiconductor industry. You are making a high-stakes wager that a few specific companies will keep winning in a market that already expects them to be absolute perfect. This creates an enormous amount of concentration risk. Think about it and give it a second. Your portfolio's performance is basically tethered to the earning reports of just a couple of companies. One piece of bad news, a slight miss on quarterly earnings, a new regulation, or a geopolitical flare-up involving a tech company like TSMC could send shockwaves through your entire so-called diversified holding. What if I told you there's a way to bet on a different, but just as critical part of the AI supply chain that most people are overlooking? This is where a brand new and very different fund slides into frame. Just a week ago, Roundhill Investments launched the Roundhill Memory ETF, ticker DRAM. This isn't just another semiconductor fund. It's the world's first ETF built to give investors pure, direct exposure to the memory and storage companies that are the true backbone of the AI ecosystem. The philosophy behind DRAM is pretty simple actually. It deliberately ignores the mega-cap darlings like Nvidia, AMD, and TSMC. Instead, it zooms in on what it sees as the real, underappreciated bottleneck in the AI revolution, which is memory. The fund's managers argue that as AI models get exponentially bigger and more complex each day, the demand for high-performance memory isn't just growing, it's literally exploding. And the existing ETFs, with their diluted, wide-ranging exposure, just don't capture this specific critical trend. It is designed to invest in companies that get at least 50% of their revenue or profits from semiconductor memory products. We are talking about the makers of high bandwidth memory, HBM, plus DRAM and NAND flash storage. Here are the current holdings of this ETF: Samsung Electronics, Micron, SK Hynix, Kioxia, and many more. I think it is a good ETF if you want to invest in memory shortage and don't want to pick one specific company like Micron or Samsung. Nothing in this video is a financial advice, it's just my thoughts plus news on this new tech ETF called DRAM. Okay, then let's just check the investment thesis on DRAM. Why memory is the new bottleneck in the AI race? So why on earth would you make such a concentrated bet on just memory? The whole idea is built on a fundamental shift in computing. For decades, the processor, the brains, was the star. But in the age of massive AI, memory and data bandwidth have become the critical bottleneck. If a GPU like Nvidia's H100 is the powerful engine of an AI data center, then a high bandwidth memory is the super Octane Fuel, and a 10-lane superhighway it needs to run. These AI models are so enormous, and the datasets they train on so vast, that the speed at which you can feed the processor is now just as important as the processor's speed itself. An AI accelerator is essentially a paperweight without its HBM, which is now designed as an integral part of the whole system. This has kicked off a ferocious and unprecedented demand for HBM. The supply is so tight that manufacturers like Micron and SK Hynix are reportedly sold out for all of 2026. This isn't just a temporary shortage, it's a structural shift. This intense demand is wrecking and reshaping prices as manufacturers pivot their production lines to the more profitable HBM. It's creating a supply crunch for conventional DRAM, used in everything from PCs to servers. This has sent prices for legacy memory soaring, with some analysts predicting huge increase in 2026. The memory market is in what many are calling a super cycle, with some forecasts projecting the market size to grow to over $440 billion by 2034. The DRAM ETF is built to capture this exact dynamic, while other funds dilute this trend across dozens of unrelated companies. DRAM offers a direct, concentrated pipeline right into the heart of the memory boom. It's a bet that as AI keeps growing exponentially, the companies that provide its memory will hold incredible pricing power and strategic importance. If you are getting some value out of this breakdown and want more analysis on unique investment ideas in tech, do me a favor and hit that like button below. Thank you. Investing to memory companies might be beneficial, but there are also some risks as always. First and foremost, that concentration is a double-edged sword. With nearly 3/4 of the fund in just 3 companies, your investment will live or die by the fortunes of Samsung, SK Hynix, and Micron. This isn't diversification. A company-specific problem, like a factory shutdown or a botched product launch, could have a devastating impact on the fund's value. Second, the semiconductor memory industry is famously cyclical. It has a long and painful history of boom and bust cycles. Periods of insane demand and profitability are often followed by oversupply and crashing prices. While today's AI-driven demand feels different and more permanent, chip makers are now racing to add capacity, which is exactly what has led to a glut in the past. Okay, thirdly, there is the timing. The launch of such a specific thematic ETF is ringing alarm bells for some analysts as a potential contrarian indicator. The financial services firm BTIG called the fund's launch a possible contrarian sell signal. They pointed out that the fund launch after memory-related stocks had already gone on a parabolic run, with one index surging 350% in the past year. Historically, the launch of these niche ETFs often lines up with a market peak right when enthusiasm is at its highest and just before a correction. They point to examples like the first Bitcoin futures ETF, which launched right before a massive price collapse. The argument is that the launch of DRAM could be a sign that smart money is heading for the exits, while retail investors are just starting to pile in. Finally, there is a risk of optimization. In last days, Google and Nvidia developed new memory compression technologies which affected this field hugely, and other companies are looking like these type of solutions as well. Here you can watch what Nvidia just developed and how it might affect memory company stocks and this ETF called DRAM.